Welcome to TalkTickers. You're looking for the essential insights from today's earnings calls, and well, that's exactly what we deliver.
Yeah.
Today, we're diving straight into the Ally Financial first quarter 2025 earnings call. We'll pull out the key results, the strategic thinking, the stuff you need to know.
Sounds good. And Ally, well, they presented a picture of pretty steady performance in Q1. This is all happening within that somewhat, let's say, unpredictable economic landscape we're seeing.
Right. And they had some big strategic moves happening, too.
They did. The big one was completing the sale of their credit card business. That finalized April 1st. And they also executed some securities repositioning transactions.
Okay.
Their core businesses, the franchises, they showed, good resilience. Although they did flag higher insurance losses, mostly weather-related stuff.
Gotcha. So let's maybe snapshot some of those key figures then. Deposits, how did they look?
Deposits reached $146 billion.
Yeah.
And they're serving 3.3 million customers now.
Okay, 146 billion. And on the lending side, there are corporate finance loans.
Yeah, the HFI loans held for investment, those grew. They're sitting at $10.9 billion.
And I saw something about a sports partnership. Kind of interesting.
Yeah, a bit different. A multi-year deal with the WMBA. They're the official banking partner now.
Oh, okay. And looking ahead, what about guidance? Specifically net interest margin, the NIM.
They reiterated it. So no change to the full year expectation. They're still guiding to between 3.40% and 3.50% for the full year NIM.
Okay, sticking to the plan there. What about the bottom line for the quarter itself? Adjusted EPS.
Adjusted earnings per share came in at $1.58. Core pre-tax income was $247 million.
And revenue.
Adjusted net revenue hit $2.1 billion for the quarter.
Okay.
And that quarterly NIM, specifically for Q1, landed at 3.35%. That was actually up just slightly, 2 basis points from Q4.
Okay, so a lot going on. Feels like a quarter with some significant strategic shifts underway. What was the main message from leadership on that front?
Yeah, the CEO, reflecting on his first year, really hammered home a few key things. Culture was one, doing things the right way. Talent development and making sure everyone's aligned strategically.
Right.
He also talked up the Ally brand itself, sees it as a real competitive edge, mentioned high net promoter scores, positive social media buzz, that sort of thing.
And the overall strategy is?
To become more focused company. That seems to be the mantra. Prioritizing dealer financial services, their auto lending, corporate finance, and deposits. Really doubling down on the core.
So that sale of the credit card business fits right into that focus theme, doesn't it?
Exactly. It's central to it. Selling that business, well, it significantly strengthens their balance sheet, gives them more capital flexibility.
Right. For what? Investing back in the core? Paying down debt, maybe?
Precisely. Investing in those key areas, maybe potential share buybacks down the line, too. And alongside that, the securities repositioning they did, that's aimed at reducing their sensitivity to interest rate swings and hopefully boosting net interest income over time.
Okay, makes sense. Let's pivot to that core then, auto finance. That's really Ally's bread and butter, isn't it? What were the highlights there?
Definitely their heartland. Consumer auto originations were strong, $10.2 billion in Q1. And that was driven by a huge number of applications. 3.8 million, which they said was a record.
Wow, okay. And the quality of those loans?
Yields on those new loans climbed to 9.8%. And importantly, a big chunk, 44%, were in their highest credit quality tier. So suggesting a real focus on prime borrowers.
So they're managing risk there.
Yeah, they highlighted their ability to kind of dynamically adjust pricing and their risk appetite based on what they're seeing in the market.
And what about the insurance side of the auto business?
That saw decent growth too.
Yeah.
Written premiums were up 9% compared to last year. They mentioned getting deeper penetration with dealers, more product adoption.
Any particular strength?
Yeah, dealer inventory insurance. That exposure grew substantially, something like 30% year over year.
Okay. Shifting gears again, corporate finance. You mentioned that as a focus area. How did that perform?
Delivered strong results, actually. Pre-tax income of $76 million.
Wow.
That translates to a really robust 25% return on equity.
25%, that's solid.
Very solid. And maybe even more notable, 0 net charge-offs in that segment for the quarter.
0. That's impressive. Says a lot about the loan book quality.
It really does. Their strategy there is, prudent organic growth, expanding carefully within their existing verticals and maybe dipping into some new ones selectively. And as we said, those HFI loans are up to $10.9 billion now.
Okay. Let's talk about the other side of the balance sheet, the digital bank and deposits. Critical funding source. What's happening there?
They emphasize continued investment, not just chasing rates, but really building out the digital experience and product set. keep customers sticky for reasons beyond just the yield.
And the numbers.
Balances grew to that $146 billion mark we mentioned across 3.3 million customers.
Yeah.
Interestingly, they said strong flows from existing customers actually allowed them to pull back a bit on their liquid savings rates.
So they didn't need to pay up as much.
Seems like it. And they also highlighted that a very high percentage, 92% of their retail deposits are FDIC insured, which is good for depositor confidence.
And the outlook for deposits for the year.
They expect balances to be roughly flat for the full year, basically aligning their deposit gathering with their funding needs for assets.
Okay, let's dive into that net interest margin, the NIM, a bit more. You said 3.35% for the quarter. What were the moving parts there?
Right. So net financing revenue, if you exclude OID, was pretty stable year over year and quarter over quarter. But the actual net interest income for Q1 was impacted by a few things.
Like what?
Well, fewer days in the quarter. That's a simple one. Lower balances in commercial auto, some softness in lease vehicle remarketing values, and just the sort of lagged impact of previous rate changes working through the books.
Okay, so some headwinds in Q1. But looking forward, they still expect NIM to grow overall for the year?
They do. The expectation is that growth will come from a few areas. Expansion in retail auto yields as older, lower-yielding loans roll off, shifting the overall portfolio mix towards higher-yielding assets, and crucially, lower costs on the deposit side as things reprice.
And these factors should offset losing the income from the credit card business.
That's the plan. They expect those positives to more than cover the impact of the card sale.
You mentioned lower deposit costs. That seems key. How are they achieving that?
Well, their overall cost of funds did decrease significantly in the quarter, partly repricing deposits downwards where they could, like those liquid savings accounts, but also a big factor was CDs maturing.
Higher rate CDs rolling off.
Exactly. They had about $12 billion worth of CDs mature in Q1 alone. The average rate on those was 4.8%.
Oh.
As those roll into presumably lower current rates, that provides a nice tailwind for their funding costs and helps the NIM.
And they seem confident about managing those deposit costs going forward.
Yeah, they express confidence in hitting their target deposit beta, that measure of how much deposit rates move with market rates of around 70%.
Okay. Let's talk capital. How is the balance sheet looking from a strength perspective?
Pretty healthy. Their CET1 ratio, Common Equity Tier 1, stood at 9.5%.
And what does that mean in dollar terms?
It represents about $3.7 billion of capital above the minimum regulatory requirements. So a decent buffer.
And the card sale obviously helped that number.
Significantly. That sale provided a big boost to the CET1 ratio. Plus, as we mentioned, the securities repositioning helped trim down some of their interest rate risk exposure.
So the plan is to use that strength to
support core business growth. And potentially, as earnings continue to expand, look at share repurchases again. They also announced the regular quarterly dividend, $0.30 per share.
And book value.
Adjusted tangible book value per share, they pointed out, has shown significant growth over time. So building underlying value.
All right. Credit quality, always a huge focus for any lender, especially in auto. What were the trends Ally discussed?
It was a bit mixed, but mostly encouraging, I'd say. Consolidated net charge-offs, and specifically retail auto charge-offs, actually declined year over year.
Declined. That's interesting, given some broader concerns.
Yeah. Now, delinquencies, people falling behind, they acknowledge those remain, somewhat elevated compared to historical lows. But they highlighted that the flow-to-loss rates are strong.
Meaning?
Meaning, even though more people might be initially falling behind, a smaller percentage of those delinquencies are actually progressing all the way to becoming losses for Ally. They also noted improved payment behavior among those who are delinquent.
Any signs from newer loans?
Yeah, they said the delinquency trends on more recent vintages remain encouraging. So loans originated more recently seem to be performing well.
Okay, but any negatives on the credit front?
Well, their coverage ratios, the reserves set aside for potential future losses, did see some decreases, both consolidated and for retail auto.
So they're holding slightly less in reserve relative to loans.
Seems that way for the quarter. And importantly, they made it clear their return guidance doesn't assume any future releases of those reserves. So no built-in benefit from lowering provisions further.
Got it. Were there any specific call-outs, good or bad, within the different business segments?
A few things. The main auto segment saw pre-tax income dip year over year. That was mainly due to lower gains when selling off-lease vehicles compared to a year ago, and also those lower commercial auto balances we talked about.
But retail auto yields were up.
Retail auto portfolio yields grew slightly. And importantly, the originated yields on new loans were up, driven by the mix. Lease remarketing did see some losses tied to specific models, apparently, but they said performance there improved later in the quarter.
And insurance.
Insurance core pre-tax income was down quite a bit. That was almost entirely due to those significant weather-related losses they mentioned, even though underlying premium growth was strong. Corporate finance, as we discussed, just continued its strong performance.
Okay, so wrapping it all up, what's the overall feeling about the outlook for the rest of 2025 and maybe beyond?
The message was basically steady as she goes on, the full year outlook. They're keeping it unchanged from prior guidance. But, with the caveat that they're watching the macro economy, potential tariff impacts, all that uncertainty very closely.
They still feel confident about their medium-term goals.
Yes, they expressed confidence in hitting those mid-teens returns over the medium term. But they were clear it depends on a few things happening.
Like what?
NEM expansion continuing, retail auto losses moderating or staying controlled, keeping a lid on expenses, and smart capital allocation, including those potential buybacks.
And the tariffs. Any specific thoughts there?
Yeah, they touched on that. Near term, they thought tariffs could actually provide a bit of a boost to used car prices, which helps their collateral values, maybe even pull some demand forward. Longer term, though, the focus shifts to the bigger picture. Inflation, consumer health, affordability, how tariffs play into all of that.
Right. Okay. That's a comprehensive look. Now let's transition to our This Is Not Financial Advice segment. Time to brainstorm some, let's call them outrageous but plausible trade ideas based on everything we've just discussed. And just to be crystal clear,
this is absolutely not financial advice, just thought experiments. Don't run off and do these without your own research.
Exactly. Purely for discussion. So thinking about Allie's stronger balance sheet postcard sale, that focus on core auto, maybe potential used car price lifts.
Yeah.
What kind of unconventional ideas spring to mind?
Okay, here's one potential angle. Outrageous but plausible, trade idea one. You could consider going long Ally Financial, but pairing it with a short position in a competitor that's maybe more skewed towards subprime auto lending.
Okay, a pairs trade. What's the thinking there?
The rationale is betting on Ally's focus on higher credit quality. The idea is they might navigate a potentially choppy auto market, maybe one influenced by tariffs, better than a lender with more exposure to lower credit tiers. So Ally outperforms the subprime focus player.
Interesting. Betting on quality differentiation. Okay, what's number two?
Outrageous but plausible trade idea two. This one involves options. Consider maybe a long call option strategy on Ally. Thinking about an expiration date, maybe out towards the end of 2025.
And the thesis for that?
You'd be betting that the market isn't fully appreciating the potential upside. Specifically, that the expected NI expansion materializes, credit performance stays strong, maybe gets that little boost from used car prices, and all that combines to drive Ally's stock price higher, perhaps more than currently expected by late next year.
So a bet on positive surprises and continued execution.
Essentially, yes. But again, high risk, purely speculative thinking here.
Absolutely. We cannot stress that enough. These are just brainstorming ideas based on the call, not recommendations. Please do your own homework, talk to a professional advisor.
So wrapping up Ally's Q1, it really paints a picture of a company in transition, executing a strategic pivot back to its core strengths, navigating a tricky environment, and holding firm on its outlook for now.
Yeah, that seems like a fair summary. We hope this deep dive into the Ally Financial Q1 2025 earnings call gave you some valuable context and food for thought. What stood out most to you? How do you see those potential tariff impacts playing out in auto finance? We definitely encourage you to dig deeper and form your own informed opinions. Thanks for tuning in to TalkTickers.